Hello, everybody. Welcome to the latest episode of High Stakes. I'm Paige Soya, managing partner of K Street Capital. And today's episode is going to be all about why VCs care about board seats and how do boards really work and how that all plays out together. So we've got Brian Goldsmith, who's another managing partner of a VC that we work with and know well in the area. And he's got a ton of experience with this, ton of board seats also, and some very interesting stories. Before we kick it off, though, Brian, do you want to just introduce yourself and share a little bit about your background?
Yeah, you bet. Paige, thanks for having me. Excited to be on the podcast today and grateful for the opportunity. So I'm one of the two co-founders and managing partners at Avenue Growth Partners. We are actually a growth equity firm focused on early growth vertical software, and certainly happy over the course of today's discussion to talk about some of the nuances between our approach and more traditional VC funds. By way of background, I started my investing career at Bain Capital Ventures, spent about 8 years there, and began my early career as a management consultant before moving into the investing world.
But the most impressive thing is that you've actually been successful in VC, coming out of consulting and then wanting to get into venture. Being at Bain for 8 years helps, but not everyone can do it on their own. And you guys have an incredible track record, so it's congrats.
Thank you.
Cool. And maybe it is worth talking a little bit about your strategy and how it's different from other VCs, just the lens, because it is venture, but it's got a different spin. So maybe share a little bit.
Yeah, you bet. I think the way I'd frame it up is, if you think about the typical venture fund, it's very much a power law game, right? So they might make 25, 30, 40 investments, and a small number, maybe one or two, maybe a handful, are going to drive the vast majority of the returns for the fund. And venture funds are typically quite comfortable with relatively low hit rates, meaning a good number of their investments may not work out at all. They may not get their capital back. On the other end of the spectrum, you've got more traditional growth equity and buyout firms. Those folks are looking for solid growth with capital efficiency and more scaled, more mature businesses. And our thesis when we founded Avenue was that there was a piece of the market, this early growth space, that wasn't being super well served by either of those traditional kind of approaches. On the one hand, you have the VC expressway or the venture capital treadmill or whatever term you want to use, but it's raising a B, a C, a D, and E because it's got to be really big to meet those power law dynamics that a venture fund is looking for. On the other side, you have these traditional growth firms that are not spooked by maybe nichier vertical specific software companies, but they want to write really big checks. So we talk about that as like the traditional growth or private equity off-ramp. The only way to make that work for the kind of company we get excited about, if you're a fund that wants to write a $40, $50 million check, is to basically buy the whole business, or at least control. So we felt like there should be another path, another avenue for these early growth vertical software funds. We just finished investing our first fund as an $83 million fund. We made 8 investments out of it. So typical investment being about a $10 million check, typical ownership in the 20 to 35% range. So perhaps not dissimilar from venture in that sense. But we're looking for businesses that are bootstrapped or very lightly capitalized, still growing really well, usually 100% plus, but quite capital efficiently. 6 of the 8 investments we made in Fund 1 were actually break even or profitable when we invested. So we're looking for companies that are being pulled by the market versus buying their way there with sales and marketing spend. And we aim to be the only capital they need to go from this early growth stage to much more scaled. And with that, we think there's a much more interesting sort of return profile, both for our LPs, but also for the individual entrepreneur who has the vast majority of her net worth locked up in her business. That home runs and strikeouts approach of VC works well for the fund, but may not work well for that entrepreneur. And so we aim to be that different avenue for those folks.
Perfect. I love that. I think it's a great investment thesis that you don't see very often. And there's a lot of companies, I wouldn't say there's a lot of companies in that space, but they're underserved because they don't know what to do. They don't know which path.
Yeah. I think the other important nuance to our strategy, a lot of venture funds focus understandably on pursuing businesses that are in massive TAMs, total addressable markets. Because if you want to have return the fund potential on a really big venture fund, you need a multi-billion dollar market, particularly because you're going to get diluted down over the course of multiple rounds of capital raising. In our experience, what we saw from my vantage seat in a multi-stage venture fund, and then my partner Ryan, who was at a more traditional growth equity fund, was that there were businesses that could trade market size for market share and build really compelling businesses in markets that started out as maybe only being a $100 million addressable market. And so we think there's another really compelling path or element to the path for those entrepreneurs who are committed to owning their category and really dominating their niche.
Yeah, that's really cool. Okay, cool. Thanks for sharing that. I think that will help give people some context when they think about your perspective on board seats too. But digging into the board seats. So one of the questions I wanted to ask you, first of all, I'm on 6 boards. It's way too many, I feel.
Yeah.
It is. I need to cut 2 of them. I don't know. How many boards are you on at this point?
I am on 3 at the moment. My partner Ryan's on 4.
Okay, yeah. And maybe before we dig into some of this stuff, like for you guys, do you require a board seat when you invest, when you're leading these rounds, right? So you take one. Right?
We do. Yeah, in every investment we do.
Yeah, that makes sense. So maybe share a little bit about it from your experience, and I'm happy to chime in, but what makes a good board? What does it look like, and what makes a good board? And then after that, we can talk about all the reasons to have one and the incentives for VCs and how that plays out.
Yeah, so to me, if I were to characterize what I think would make a good board, it's number one, a commitment to candor, right? Because if you're not telling each other the truth and what you really think, like you're not going to get the most out of the people around the table, and you're not going to be able to help the business thrive in the most effective way. So candor is really important. The second is accountability. And it's worth breaking apart accountability, maybe in a little more detail in a minute. I think oftentimes it gets associated with like blame and shame. But accountability is just about doing the accounting. We said we were going to do X. Okay, we were better. We were the same. We were the worst. We were worse. All right, what can we learn from that? So I think like having that accountability and the candor then lets you make really the most effective decisions going forward. And then I think the last piece is really alignment. So if you have a board that has people on it that are trying to do totally different things with the business, that's when there's real challenges. We spend a lot of time thinking about who else is around the table. If there's someone that's running a traditional venture, I'm going to oversimplify, but like billion or bust playbook, IPO or bust, like we may not be the right kind of shared partners around the board because we're thinking about building businesses in different ways. So I think if you have the candor, I think if you work together with shared alignment and then accountability, not as a blaming tool, but as a mechanism to unlock opportunity, that sets up a really great board dynamic.
It does. It definitely does. And for us, like a lot of times when we're leading around and taking a board seat, it's the beginning of the board. The board never existed until that moment. So it's fun. You get to put the right people around the table and make a really good, strong board. But that's not always the case, obviously. And I would wonder in your case, when you guys invest, because these companies are a little bit probably later than the stage we invest in. And for a first check-in anyways, but they already have a board probably. And you're stepping into that. You're not creating it from scratch.
So it's a mix. So for our businesses that have raised a little bit of institutional capital, there is often a board, and it might be the founder or the 2 founders and maybe a seed investor. And we're stepping into that dynamic. For those that are truly bootstrapped, oftentimes there is no formal board, or it's the founder and a co-founder in a more informal fashion rather than a traditional board. So in either case, we like to think a lot about what does the ideal board construct look like. And beyond the sort of 3 characteristics I described, I think the only other thing I would add in is complementarity of experience can be really additive. So as an example, one of the boards that I'm on for a business that's now almost 20 million in ARR, it was a couple million when we invested, has been since inception, initially it was the founder and CEO with 1 informal advisor. And then since we invested a little over 3 years ago, it's been the CEO, me as the representative for Avenue and the Series A, and then an independent director who built and has been running now a quite scaled business for about 15 years. And that experience for him as a founder and operator, I think is quite complementary to my experience as an investor in setting up the CEO to have a board that's got a diversified set of perspectives.
Absolutely agree. And actually, you teed that up perfectly because there were 2 other things I wanted to talk about related to this. And one of them was independent board members. When do you bring them in and what's your view on them and how they can be helpful? I know you just touched on this, but...
Yeah, I think, let me step back. A lot of the companies when we invest will craft in the deal documents a board structure. As an example, our final Fund 1 investment, we crafted the idea that the board would be the founder, then me, and an independent director. And the founder had suggested, hey, let's put in a 3-month or 6-month time clock to find that independent director.
Yep.
And I pushed back on that. I said, we don't need a time clock because then we're going to get the wrong person. Let's get to know someone, really make sure they are excited about what we're building. Let's have them sit in on some board meetings. And in fact, the independent director we brought in sat in on 2 board meetings, and not just sat in, but contributed. And let's see, are they additive? And then also, do they have the time to do it? Because I think that's the challenge. A lot of companies will stretch to get this theoretically amazing board member. But the reality is, if they don't have the time to attend all the meetings, to prep for them, and then to be available to the CEO outside the board meetings, it's not super useful.
Yeah, exactly. And I also just want to point out that's actually really common for our audience that might not know this situation where you want to get an independent, but the founder wants you to decide quickly because maybe they want to have they don't want you as a board member to have too much power at the table when you're waiting on that other board member to get there. But it's super common not to put a time limit on that because, to your point, like, you want to get the right person. You don't want to just put somebody there because you have to. And I think that's super important lesson.
Totally. And there's other ways to solve for the potential founder concern around, okay, if the board is only 2 of us out of the gate, are we deadlocked? There's other ways you can solve for that in deal docs or otherwise.
Exactly. Yeah, exactly. So what advice would you give to first-time founders who are building a board for the first time?
Find people you want to work with, but who are willing to have hard conversations with you and give you the time needed to really help you thrive. And I think if you do those things, like, you'll be in a pretty good spot.
Yeah, I think it's probably the most important thing. Obviously, you want to make sure that the people that you choose are relevant, that have different expertise that is helpful to you where you have holes. Like, where does the business have holes? And
for sure,
who else can help us set the strategic direction of the company in the best way possible? I think these are all things that people think about. But the last topic on this, like just boards in general, I wanted to bring up is just going to the board meeting is one thing. People think that this glamorous board seat is so wonderful.
Sure.
You show up and then you go out to dinner and that's the end of it. But it's not, right? There's a lot more work in being on a board. And I wanted you to share some of your perspective on that. Like, what work is it and what does it look like in practice for a good operating board?
So it depends on the scale of the business, right? So at one end, and I haven't experienced this, you have public company boards. But I was part of the board of a company that was preparing to IPO, and I stepped off the board effectively right before the business went public, 10 days before it went public. As you're getting to that level, you've got board subcommittees on a variety of things. You have an audit committee, you have a compensation committee, you've got a whole bunch of things that start to come into play where you have separate committee meetings in addition to the board meeting, and then associated responsibilities related to those things. It would scale it back down to the earlier stage where you all are investing and kind of the early growth stage where we invest. I think you don't want there to be too many surprises in the board meeting. And there's advice out there, which is you should have a pre-meeting with all your board members. I'm not necessarily saying that. I think that can lead people to spin their wheels a lot. But I do think you want to make sure your board comes in with enough context that you don't have to re-educate them on what your business does. Yes. You can have really valuable conversations. And so the conversations that happen in between board meetings, leaning on the expertise of any given board member, is really important. And then certainly having a regular cadence of good materials, whether it's monthly reporting or quarterly, that people can review and ideally ask questions on before the board meeting is really valuable, so that instead of reading people through a 40-slide board deck, you're like, okay, we know you've read the deck. We have 3 key discussion topics we want to spend time on.
Exactly. Yeah, I think that's a really good point. And then what's your view on the size of the board?
I think for early growth companies, 3 to 5 person boards are healthy size. Once you get to much more than that in the boardroom, it's a lot of people to manage.
Yeah. Exactly.
And oftentimes I think for venture companies, what will happen is you'll end up with 3-4 different investment funds, the seed fund, the Series A fund, the co-investor, the Series B, and you get skewed to too many investor perspectives, which may or may not always be aligned with each other. And so I think it's important to try to keep the board size reasonable. And that means over time, sometimes folks will step back, right? And as we think about bringing in the next investor into our companies, again, they're not running a traditional venture path where they're going to raise a Series B or a Series C or what have you, but they will at some point do more of a traditional growth round. Could be a partial recap, could be all primary, could be even a full recap. In those scenarios, there may be times when we do choose to step back and let that new investor take the driver's seat. And we become more of like that advisor to the CEO, whether or not we're still on the board.
Exactly. Yeah. Most of the boards we see and sit on are probably 3 to 5, maybe 6 people at most. I have seen a couple, not the ones that we invested in, that had 8 to 12 board members and so dysfunctional. And it's exactly what you just said, where you've got every investor that came in that led any term sheet ever has a board seat since the beginning of time. And it's everybody has different liquidation priorities and different motives. And it's just it creates a less productive situation. Yeah. Cool. Okay. And then now let's talk about VCs like us. Like, why do we want the board seats and how that piece of it plays out?
Yeah, I think there's a few sort of key elements to it. One is there are a set of specific governance rights that you get by virtue of having a board seat. Now, as a investor, venture capital or growth equity, you can get many of those same governance rights by virtue of the shares you hold, whether or not you have a board seat. So it can be useful to have both. But I think oftentimes the board seat, because you can get those protections with your shareholder rights, ends up being around that alignment and impact, right? So you want to be able to ensure you have that ongoing alignment. And then a big part of what at least our LPs back us for is our ability to add value to the businesses we support. And while you don't have to be on the board to do that, I think it's much easier to do if you have board level visibility, board level trust, board level relationships to be able to lean in on different operational and strategic initiatives to be able to help the business grow and grow more efficiently.
Yeah, exactly. I mean, that's basically how we think about it. We think about it like we want to be able to help guide the company's strategic direction and help shape that. But we also, from a helpful feedback kind of way, not we don't have control, we don't take control positions, and we don't tell founders what to do, but you want to give that level of guidance and support for things that they may not have experience in, number one. But number two is just to support them. Like whenever there's a challenge or an issue or things come up, right? This is startup territory. So there's always something, right? There's always something every year that you're like, wow, I can't believe that we're talking about this, but that's what happened. And now we need to figure out what to do about it. So I think that, and then 3, to your point, protective rights, right? You're representing your LPs and your investors and your position in that company, your stake in that company, and how that plays out when there's like an exit or when there's new money that's coming in or whatever. That's where it becomes really important. And having that visibility, to your point, allows you to think through with the company what you should do and how you should use your own fiduciary responsibility to your fund to help make sure that's represented in the conversation.
Yeah, for sure.
Yeah. And then I was also going to ask you, have you ever had a situation where you didn't take a board seat, where you guys did make an investment but did not take a board seat at all?
Not here at Avenue. At my prior firm, yes.
Okay. And what were the reasons for not taking one?
It was primarily a function of the size of the check relative to our fund size. So very specifically, I, at my prior firm, mostly did Series A, B kind of stage investing. The very last deal I did there was a seed deal. It was in a sector I knew super well, but it was $1 million check, and we had quite a large fund. And board seats on those, you end up with so many seats, it becomes hard to scale.
Yep.
So we were active. We had what largely looked like more working sessions than board meetings, but still with a very regular cadence. Maybe it was might have even been more frequent than the typical quarterly cadence. It was probably every month and a half we'd get together, but it was more collaborative working session than it was traditional board.
Got it. Yeah. I just wanted to point out for our audience of both founders and investors who want to take board seats, like if you're a founder and your VC or somebody doesn't want to take a board seat, it's not necessarily that they don't care. They're not going to be supportive. Like you just said, like you can still do those things outside of the board, but there's a lot of reasons why you might not take a board seat. Like for us, it's time, right? We have 50 portfolio companies. We don't have enough people to take every board seat. So we have to be very selective about the ones that we think we can add the most value in. And that's all it is. It's not that we like one company better than another. And I think that's just part of how it works.
And in the world of inside baseball, for founders' benefits, like different VC and growth funds are going to have different incentives as to how they think about board seats. Some of them are going to insist on one in every circumstance because they tell their LPs they do that, rather than insisting on one in every circumstance because like they really think they can be impactful. And others might want to take a board seat, but actually worry about the perception from LPs of them having too many board seats. And so they will say, no, I don't need a board seat here, but I'm going to be, to your point, they can be equally as helpful. But there are these dynamics that can be going on behind the scenes that can impact your investor's decision as to whether or not they want to take a board seat.
It's a good point. And another thing to bring up is if you're a founder and you have too many people on your board and you don't want to put more people, you can always do observer roles, and that's like fine, right? That's you don't want to get too many observers either, but that's a way to let people have visibility and see what's going on, but they're not necessarily part of the actual board.
I think that's true, although it's important to set clear expectations as to what the role of an observer is in any given board. So I've been part of boards where, earlier in my career, I was an observer, and it was expected and welcome that I would be as active a participant as any of the full board members, with the caveat that I couldn't vote. And then there are other boards where, as an observer, it's your opportunity to hear what's going on, but your spots where you're going to chime in, at least in the full meeting, because of the number of people around the table, are going to be few and far between, if any.
Yeah, that's a good point. It really depends on the situation in the company. There's one board that I guess I am an observer on it still, but I can come to the meetings if I want. I don't have to. I'm listening in. It's more for visibility than anything. Yep. And they are the only contributors to that board are the actual board members themselves. So that keeps it productive and just clear that everyone knows what their responsibilities are supposed to be.
We do ask for an observer seat on every deal we do, and we've gotten it on every deal we do for kind of two reasons. And we give it to one of the junior or mid-level folks on our team. The first reason is it actually allows them to be up to speed on the business, and therefore, from like a adding value perspective, be able to lean in and help with a variety of things without needing to be re-educated. Mm-hmm. And so I think our founders actually really appreciate it. But the second thing is we want to give those folks the opportunity to see what a board looks like, because one day we hope they will grow into partners and be sitting on boards.
Exactly.
And certainly I benefited from that earlier in my career, the ability to watch really talented board members and really good boards, and candidly, sometimes pretty mediocre boards, and be able to learn from that and hopefully develop my own capabilities and style.
Cool. I actually have never heard anyone doing that before, but so you guys will take a board seat and an observer seat and do it like that. That makes a ton of
Correct.
sense. I don't know why I haven't even thought of this, but you're right. It's re-educating your own investment team, and then they can't scale the information as quickly because they weren't there, and you're never going to give them the exact information exactly the same. So it's a great idea. I might steal that one. Super cool. And then what are some examples of, if you have any at this point, examples of times when you were on a board and the board materially impacted the company, whether positively or negatively?
So there's one company that immediately comes to mind where the company had a lot of confidence in their ability to achieve their budget for the full year. And we had our end of Q1 board meeting. So that happened in like April or May. And they presented it to us, and we saw a bunch of softness in the data that I think they were so in the weeds that they weren't seeing it. And what we were able to do, therefore, was to suggest to them that they make a plan for what they would do if that softness materialized, such that they weren't caught flat-footed at that point. So this business, trying to think, I'll get the calendar year wrong. But anyhow, they saw the potential slowdown that was coming in their market much earlier than they would have. And they made the hard decision to actually let go of some folks on their team. But they did that probably a year before a lot of other companies in their market or in the SaaS market more broadly were making changes. And that means now that they still have plenty of capital to be able to continue to iterate and find what is really working. So I think just helping them see the potential challenge sooner. Again, not forcing them to have to make a decision at that point, but be prepared, allowed them to act and react much more quickly than I think other companies might have.
Yes, I am thinking of a similar story where that happened, and I wasn't a board member, I was an observer, and nobody listened to the softness. And then you get to that situation, and then you're in a recap situation or something bad.
Or a bankruptcy situation, or just really painful.
Really painful. Yeah, exactly. Major rifts and really painful. So I think that's one of the best ways that boards can help, like helping, especially founders who don't know how to manage cash flow, right? Like that's not a skill that everyone has, and they're not thinking about it from that perspective. I think especially with your background being an investor by training, like by trade for so long, you think of this stuff immediately all the time. And that might take a founder 6 months too late to even have considered it.
Yeah, there's another one of our companies that is performing extremely well that was looking to effectively help their end customers who use their software get 3-4 times as much output from the software as they were in the early days of this company's offering. And at the time, they had a manual component to how they provided. It was effectively, there was a little bit of tech enablement in addition to the software. And the cost of that was quite high. And so this company was talking about helping their customers get 3 or 4 times as much output from it. And I basically called time out in the middle of the November-December board meeting. It was like, if you do that without raising prices and without meaningfully driving cost of goods sold down, you will go bankrupt. Even if, in fact, more quickly if you're really successful from a sales perspective. Because your cost of goods sold on an absolute dollar basis, if it 3 or 4X's and you don't triple your price, like that's not going to work.
Doesn't work.
And I think the founder was so excited about the sales traction they were seeing. They knew there was a potential issue here to solve, but I don't think they necessarily appreciated just how critical it was going to be. And again, that's a role, and the independent director in that instance basically said the same thing. Hold on, there's a lot of good stuff happening, but you have to solve this issue or just the cash flow dynamics won't work.
Exactly. Yeah. And I think that's really what the benefits of having a board are, is to do that and to sort of have that other set of eyes on what's going on, but not in a controlling sort of way. Like I have sat on boards myself, not with other board members who I think were not great board members, and they can be very challenging to get along with for the founders over time. And I think like part of when you make an investment and you take a board seat, you're trusting that founder knows everything about this. They know more about it than we do. And we might be smart investors, whatever, but like they're the ones running the business and they see it every day. And the way they're thinking about things, you need to listen to it. It does matter. But then being able to layer on that other level of expertise that can help them take both things and come to the best decision is the best way that a board can function, I guess, I would say. Okay. And then I also wanted to ask you how you feel about this question.
Sure.
How much of the desire for a board seat is about governance and oversight versus influence and trust building?
It depends on the firm, I think. For us, it's largely about influence and trust building and related to that value creation. Again, you could achieve many of the same governance things through your shareholder rights. So I think the biggest impact comes from the influence.
I think that's right. But also, like, you have to think, just for most people's knowledge, is when you're investing in the early stage, you've got like a 10-year trajectory in a lot of cases. A lot of things are going to change and happen during that period of time. And it ebbs and flows. Like, there might be a time when the founder leaves and you have to pull in a new CEO and it's a whole different situation. And then maybe it is a lot more oversight and governance than whatever. But it changes over time. And I think, but having it in place is the important thing, at least.
Yeah.
And then,
Go ahead.
Were you going to say something?
I was going to just offer one more thought, harkening back to the beginning of the conversation around what makes a good board member, and then talking about these times of crisis and this ebb and flow. One of the things one of the senior partners that I worked with at my prior firm said that I really liked was, he talked about this idea that if you imagine a scale from 0 to 10, where 10 is, I'm so excited about everything, just amplifying all the highs, and 0 is everything's negative and I'm amplifying all the lows. He was like, I try to operate between a 4 and a 6. Like, yes, I want to celebrate the wins with a founder and their team. And sure, I need to empathize and help when the losses are coming. But the founder has enough of that roller coaster dynamic. And by the way, now being a founder myself of a fund and having lived that experience for the last 5 years, you have enough of the highs and lows. And so I think a really good board member dampens rather than amplifies those highs and lows. And I don't mean dampen in a bad way. They just help reduce the magnitude of them and help you stay steady and see that there's pretty much always a path forward if you can step back and get to clarity.
Yeah, that's a really good point that I didn't even wish I had thought of, because it is so important. Like, the founder journey is very hard. And you're only seeing part of it, right? You're not seeing the day in, day out of it as a board member. And I think being able to be a trusted, I don't want to say a friend because you're not a friend if you're on the board, but like to be a trusted advisor to you in those times and to just have an even level keel personality that can, something really bad happens, it's okay, let's just dissect it and figure out what to do instead of panicking and freaking out and creating chaos. That is a good board. I know that doesn't always happen, but that is what a good board should do. And then the last thing I wanted to ask you is, how do you balance being like a supportive partner on the board and being the fiduciary to your fund when those two things come into conflict?
Yeah, so I think you can always be empathetic and supportive. There's a nice way to treat people, whether times are good, times are bad, incentives are aligned or misaligned. Like, yeah, I don't think they have to be in conflict. Now, there can be situations where, particularly by virtue of liquidation preferences, if you have a preferred stock that gets paid out and you have a business that is underperforming, you as a shareholder would happily sell the business for a penny more than your preference if you're top of the stack. If you felt like it wasn't going to get back to the place where you convert to common, or it was going to take a really long time to get there. Yeah. But we don't have control. We can't force a sale, and that's not going to work for the founder, and it may not work for the other investors if there's investors around the table. It might seem like your shareholder duty is in conflict to your board duty, but in reality, like, what you might want as a shareholder won't get done. So you've got to work to drive alignment and influence and find a win-for-all solution. So there can be times when shareholder and board fiduciary duties diverge. But again, I think in reality, you can always be empathetic, and there are ways to find win-for-alls, because otherwise it's, as a non-control investor, hard to drive the action you might want anyways.
That is also what I believe. And I do think I'm glad you brought this up, because that was the last thing I was going to mention, is just the board really comes into play in scenarios when there's an exit. That's when it matters probably the most, right? That's when you're trying to figure out if you're going to take the offer, what it's going to look like, or if not, what's the alternative path, or like those are like the spice of the board meeting that you get to over a 10-year period with the company at that moment, which is exciting and fun, but also that's, I think, the biggest role and probably why VCs want to have that board seat in the room for that moment, right? So, any case. Okay, so now I want to switch gears and ask you a couple of other questions.
Sure.
We talked about this earlier, but what do you think, in your opinion, is the most interesting inside baseball thing about venture capital since you've been in the space? You've been in the space for a long time, like most of your career, so it's probably hard for you to even think about when you weren't in it, but I'm just curious your perspective.
I think there's a fear of hard conversations that can play out in lots of different parts of the venture and growth world. I think a lot of people end up in venture or growth that are really smart and really curious, but aren't always like the best managers, right? Like really capable managers who are really smart and curious, like go to companies themselves rather than investment funds. And they manage big teams and they get excitement and motivation from that. And as part of that, to thrive at that, you have to be good at hard conversations. Because like you can't manage big teams if you're not. I think a lot of investors are not always the best people managers and are not always therefore very comfortable with hard conversations. And so I think that can play out in some of the kinds of board dynamics we talked about, particularly if you're running more of a venture strategy where you've got this like home runs and strikeouts. It's like cheerleading on until, it didn't work, but that's okay for me as a venture fund because I have a big portfolio. And I think that's the thing that sometimes founders don't always see is like their investor may have incentives not to have hard conversations or just may not be that great at having them despite seeming really successful and being really far along in their career.
Is that something that you felt coming into the industry then, yourself in your investing role? You get to a point where you were like, man, I'm not having the hard conversations I think I need to be having. I need to change that.
There was an element of it. So when I started my career at Bain & Company, I think Bain & Co., which is one of the big management consulting firms, is absolutely phenomenal at onboarding new talent. They've got, I don't know how many offices around the globe now, 40, 50 offices, and they probably bring in something like 10 or more people per office per year. They're bringing on hundreds and hundreds of new people straight out of college every year. And so they built out really great, robust training programs, and you get a lot of attention. And they train you how to manage as you spend more and more time there. I think a lot of investment funds, they're small organizations. They might bring on one person a year or one person every few years. And a lot of the learning is apprenticeship. And some of the things you may not always be taught about how to manage. And there may be hard conversations that are happening, but you may not be in the room for. And so you see that you don't see them. So there is an element of you need a boss who will, and I was fortunate to have one, a number of them at Bain Cap Ventures, who will pull you in and let you watch, or at least give you the full rundown on those hard conversations so you can learn how to have them.
Yeah, I think that's a good point. I've never thought about it like that, but you're probably right because with a lot of early stage venture careers, that is the path. And if you didn't come in, I came into venture from being an operator, founder, so this was nothing new to me. And if it's your fund and you found your own fund, then that's probably not an issue. You've probably had hard conversations before.
Yeah.
Or you wouldn't be in those shoes. But for anyone that's learning their way up, working for another firm, like maybe that is a harder thing, I think, to train. But yeah, that's super interesting. Okay, next question is, what is your biggest failure and what did you learn from it? And this could be venture, doesn't have to be.
Oh, gosh. I think as my partner Ryan and I were thinking about forming Avenue, some of the biggest failures we'd seen in our careers to that point were when the business we were invested in was running the wrong play for their market. So there's one company that comes to mind that we both know quite well that had a ton of success in the early days, bootstrapping, and a lot of success after they raised their Series A. And then they went on to raise a B and a C. And there's actually multiple companies that fit this profile. And suddenly the expectations for the business, given the multiple folks around the table, require this massive exit. But they were in markets that just didn't support that, given the size of the market or given the number of jump balls a year. I don't know if you know that term, but if there's only 1,000 addressable prospects in the market and 10% will consider buying a new solution every year, there's only 100 jump balls. And like you can throw more and more sales reps and more marketing dollars, but you may not change that much. And so the law of large numbers starts to come in these constrained markets where your absolute dollars of growth are going to shrink. These companies that I'm thinking about, I think both will have fine exits in the end. They're not businesses that went out of business, but they just ran the wrong capital play vis-a-vis their market. And I think those ones in some ways are more painful than the ones that had an idea that just turned out didn't work.
Right.
Because this could have been a great business. It was really a really great outcome for the founder and for the investors if they had run the right capital strategy. So that's what comes to mind. Of course, it's a big part of why we founded Avenue is we're of the view that you've got to match the capital strategy to the founder and the market opportunity. And when you do, I think there's absolutely hidden gems that can be built.
Yeah, it's a really good point. And there's a ton, we've seen it so many times where the capital strategy has like ruined a business that otherwise is like a perfectly great business. And we've done a few recaps of those situations ourselves just because we can see that. And it's just a shame and I think a lot of that is some VCs drove part of that grow at all cost capital strategy that then bit everybody in the ass, of course, a couple of years later. And seeing the learnings of that, but yeah, that's it. Was this in this example that you're giving for yourself? Was this where you were an investor in the company, but you yourself had a vision of what the capital strategy was, and it should have been something different, and that's where you felt like you did.
Yeah, and I don't think I appreciated it at the time. One of the ones I'm thinking about was an investment that we made a few years into my time at my prior firm, and I know there's a similar one that comes to mind for me from my partner Ryan's prior experience. It's only with the benefit of hindsight that you look at it and you go, gosh, this business could have built itself to a $20 million ARR business with a really nice outcome, only ever raising $8 or $10 million along the way. And that could have been a win for everyone because that business could have been worth 150 or 200 million. And the founder or the couple co-founders could have owned 50, 60, 70%, and the employees could own 10%, and the single investor could own 25%, and everybody would have gotten a great return. But by layering 80 million, 90 million, 100 million of capital on this business, now when you exit for 150 million bucks when you're 20 million of revenue, nobody's generating much of a return.
It doesn't work. Yeah, it just doesn't work. So that's a good point. Okay, and then the final question is, what's the best advice you've ever received?
Yeah, so my very first boss, when I started my career at Bain and Company, I had a few weeks of intensive training, and then I got staffed on a case team. And he pulled me into this big client meeting. I'm 3 weeks on the job. And he said, Brian, even though you're not going to be the one talking in this meeting, anytime there's a question asked from the client that, someone more senior on the Bain & Co team is answering, or anytime someone on the Bain & Co team is offering an idea, imagine you're in the batter's box and you're watching the pitches come and you're trying to decide, would I swing? How would I swing? What would I try to do? So basically play the game as if you were the key driver on your own team, even if you're not in it. And if it's not obvious to you right afterwards as to why someone else on the team answered a question the way they did or said the thing they did, ask about it, and ask about it immediately. And sometimes it's not obvious because it's holy cow, so-and-so on my team had this amazing answer. I would have never thought to do that. How'd you think about that? Because then you don't just hear the answer, you hear why. And sometimes you might actually have an idea where you're like, that person said that. I didn't think that was that good. I actually think you could have said this. And your fresh eyes can be really helpful. So it's really this ownership mindset of like shadow playing the game, even if you're not the one that's like in the lineup. And doing that, I think, just lets you get these reps and experience so much earlier in your career that sets you up for success.
That's such a good point, because it's like if you're in those meetings, you're not the one talking. You could just be listening, and that's it. Or you could be doing the strategy that you're talking about, which is like you're learning, and if you don't understand, then you're asking so that you do understand, and then you're always understanding, and the more you understand, the faster you're going to get to the next place. So
that's it.
I love that. That's great advice. Very good advice, especially in venture, especially I feel like in our own team. I think I'm going to tell my team this when we get after this call. But that's it. This is a wrap.